certainly uncharted territory right now. Late 60s style maneuvers by the Fed and the Treasury.
Question that was actually at the center of Powell's contentful commentary yesterday, rather than foul-mouthed rants.
I think we're all old enough to remember when Janet Yellen was the Fed chair and she was banging on the table saying, hey, we've done all this monetary policy stuff, but there's no fiscal, right? So now that she's in, leading the Treasury, she's doing all this fiscal, but it's offsetting the monetary policy stuff.
Everyone wants to say that they're conservative fiscal, conscious people, but realistically, they have jobs. They have to be reelected, and their constituents want to get paid.
We would still only see a bill share in terms of the total Treasury debt stock, that's still under 30%. So that's okay.
The only issue,
2 or 3.
Yeah. So if they can't get inflation down going into an election cycle, what are they going to do?
Hi, everyone, and welcome to The Week Ahead. I'm Tony Nash, and today we're joined by Bob Elliott, Tracy Schuchart, and Albert Marko. We've got a few key things to cover today. First is rates, market, pricing, and earnings quality. We'll go in deep with Bob on that. We'll talk about small nuclear reactors with Tracy and the potentially death of new nuclear power in the U.S., and then with Albert, we'll get into elections a bit and dollar and commodities prices through the election cycle.
Want to take control of your investments and predict the stock market? CI Markets is the AI-powered platform that provides 94.7% accurate forecasts for over 1,600 stocks, ETFs, Forex, commodities, market indices, and economics. With CI Markets, you can manage your own investments with ease and supercharge your trading experience. Sign up for CI Markets today and get 40% off your annual subscription with the code SAVE200. CI Markets. Predict the stock market and supercharge your trading experience.
So, Bob, thanks again. Really appreciate you joining us again. It's always really educational. You're one of my favorite Twitter followers, or Twitter
thank
followers.
You. I appreciate it.
Always super detailed. I always learn something. So yesterday, Thursday, just before Powell dropped a bunch of F-bombs and killed the melt up, you put out a great tweet about 2-year rates. 2 years just up a bit over 5%, I believe, right now. And you tweeted this. So it's come up a little bit. The yields come up a little bit. So can you walk us through the trajectories, kind of why are rates here? Where do you expect rates to go, and what impact does that have on markets overall?
Well, I think the basic question that was actually at the center of Powell's contentful commentary yesterday, rather than foul-mouthed rants, was around the fact that inflation is still not durably at the Fed's target. And it's not just that it's not there, it's that the Fed, at least right now, doesn't see a clear and convincing path to it so that they can start to ease off the tight monetary policy that they have in place. And so I think one of the things, what we've seen, obviously, over the course of the last 6 months is a recognition that we're going to need higher rates first in order to slow the economy, in order to kick off that moderating cycle to slow wage growth, which should eventually slow nominal spending and then slow inflation. But that rise in interest rates essentially hasn't been yet enough to get there in a convincing manner. And I think one of the issues was that the Fed basically said, as of a couple of meetings ago, they were really pointing to the fact that the short rate, or recognizing the short rate, really wasn't the thing that was going to get the job done. They really needed that long end to move up. And they got some of that until, of course, Janet Yellen wrestled away the tightening that they needed through the shift in the QRA composition, bringing bond yields down.
Yeah, we don't have a team, right? I mean, they wrestle each other all the time.
Of course. And what I would emphasize is, from a roles perspective, if you actually go back and read about fiscal monetary policy in the 60s or in the 70s, this is not unusual, I would say, particularly in heightened inflationary environments, or in environments where there's, a desire to engage in fiscal expansion and populism, as well as, global conflict, to fund global conflict. And so it's not like this is a shocking move on the Treasury's part, but I do think it's an important move because it basically the Treasury has been a technocratic institution basically for the last 30 years. And now what we're seeing is indications that it's going to be a policy-making institution rather than a technocratic implementation institution. That's a big shift. And you'd be surprised at how much flexibility Janet Yellen has actually to shift the composition of duration before running into any meaningful sort of outliers in terms of the overall debt composition in the U.S.
Right. And I think we're all old enough to remember when Janet Yellen was the Fed chair and she was banging on the table saying, hey, we're doing all this monetary policy stuff, but there's no fiscal, right? So now that she's in, leading the Treasury, she's doing all this fiscal, but it's offsetting the monetary policy stuff. So, just not everyone they're just not on the same page at all.
Absolutely. And I think one of the things that was super interesting about the market action coming out of QRA was that there's basically a bid on all bonds, right? But what that ended up doing is it created a bid on 2s and 10s, and that didn't make any sense. Because if these two levers are going to work in opposition to each other, which I think, I'd say probably over the next year, we're going to see opposition between them. What that should indicate is that the Fed needs to be tighter than expected before the QRA. And given that the Treasury is going to be essentially easier than expected before the QRA. But instead, the exact opposite happened in the market action, which was Powell got priced in to ease more in 24 as a function of the QRA. And that's the thing that I think makes no sense, to be honest with you. If we're in this new world, Powell's going to have to do more in response to the easier long end policy. And so those, 75 to 100 basis point cuts that are priced into 24 certainly look vulnerable in that context.
Yes. Albert, come on in on that. I know you're done.
All right. No, I agree with Bob. I mean, we're certainly in uncharted territory right now. Late 60s style maneuvers by the Fed and the Treasury. There's no question about that. I think the bigger debate in the near term, 6 months really, is whether a soft landing is possible or not. Now, I know Bob's going to be on the opposite end of me on this one. I get it, because all fundamental guys are. There's no question. I mean, Bob's top-notch guy in fundamentals and whatnot. But for me, going into an election year and knowing how much power and the Treasury, how much power the Fed and the Treasury have of working the long bonds and everything, I just, I do think that they're going to get a soft landing just for this election cycle. After the election, it's hands off at that point. But I think that's where I really want to discuss is soft landing versus hard landing, if it's possible in 2024.
What does that look like to you, Albert? A soft landing? Can you paint that picture for us a little bit?
Break down the 3,800, 3,900, and then rally for the election. That would be, my soft landing. Obviously inflation is a persistent problem, and this is a manifestation of the Treasury and the Fed with conflicting policies that I just don't see alleviating. So that's a wild card in there.
Okay. Bob, what do you think on that?
Well, I think it's one of those things where let's say from a longer term perspective, I think the core question about sort of soft landing and the durability of a soft landing is, can the Fed bring inflation to its mandate without a meaningful weakening of economic activity? And I think, there's pretty compelling evidence over history that the answer to that is no. The way we will get inflation back to that target is through a meaningful rise in the unemployment rate. So there will be a landing, and it will be hard because that's what's necessary to achieve the Fed's goals. Now, let me pause on that point and say, but that doesn't mean tomorrow there's going to be a soft landing. And if anything, tomorrow there's going to be a hard landing. Like a year ago, felt like, a man in the wilderness saying that we weren't going to have an immediate recession, right? And the reason why that is two, I think, important points. One, macroeconomic cycles, if left to their own devices, not in a crisis mode, but left to their own devices, frankly, are like slow moving. It's like molasses. Like go back to the 60s cycles, go back to the the late 80, 90 cycle, like even the 2000 cycle took 3 years to play out, 3 or 4 years to play out. So I think we have a very slow moving economic environment. And you see that like with payrolls, which are slowing at the pace of molasses, right? Nothing too exciting. And the issue is that the ability that particularly the Treasury has, but also the Fed has to run inappropriately easy monetary policy is absolutely there. They absolutely have the capacity to be able to do that, right? Even if Janet Yellen actually reduced the amount of coupon issuance, right, over the course of the next year, reduced, we would still only see a bill share in terms of the total Treasury debt stock, that's still under 30%. So that's okay. That's not prudent. It's not a good idea. It's not good to keep stoking these inflationary pressures. But it's certainly possible, particularly if they're politically motivated. And so when I'm looking at this overall picture, what I'm saying is I'd rather not bet necessarily so directly on hard landing versus soft landing. I'd much rather bet on where are there opportunities in the market that are underpriced in that context, right? So for instance, assets like gold and oil don't look to be particularly priced that we're going to have continued inflationary pressures or continued, if I'm going to buy a growth asset, oil's the cheap, December 24 oil is like the cheapest growth asset that's out there in the world today. And similarly, if we're going to have this stimulation, these policymakers extending this cycle, then those December 24 SOFRs, they're looking like those rates are probably going to have to rise relative to what's priced in.
Yep.
Yeah, I certainly agree on the rates rising. I think that Powell will probably have another 2 or 3 hikes going into 2024, in my opinion. The only issue
2 or 3.
Yeah, so if they can't get inflation down going into an election cycle, what are they going to do? What are they possibly going to do? The issue I have is that both Powell and Yellen has the White House and the Senate on their side going in for fiscal stimulus, farm bill that's going to be coming up. God knows what other juicy little stimulus projects that they're going to pump into 2024 and just artificially keep the markets up. For me, knowing how DC works intimately is I can certainly see them keeping this pig up, at least through the election cycle.
And I think that's one of the questions in that context, like where's the best way to express that view? If you think that's or essentially where is that possibility underpriced? And that's where I think it's a bit underpriced. I think it's definitely underpriced in the short rate market. I think it's moderately underpriced in the long rate market, though, Janet Yellen will probably be responsive. If rates were to rise 50 basis points again, she'll just be a little even easier in the next announcement. It's underpriced in commodities, I think. And then if you go over and look at stocks, that's the place where it looks a little overpriced, where we have, earnings growth expectations from analysts bottom up to be, almost 12% next year. That's not like a great, that's going to be tough, even if things work out perfectly, right?
Let's get into that in just a minute, the earnings stuff.
Heads up for a short break.
Everyone, I want to tell you about a quick promo we're having for CI Markets. This is our forecasting platform for stocks, equity indices, commodities, currencies, ETFs, and economics. We're having a sale for $200 off the yearly subscription. So it brings it down from $500 for the yearly subscription to $300. Go to completeintel.com/save200. And then when you click through, hit the coupon SAVE200 and you'll get our annual subscription for $300. Thanks very much.
Thank you. And now back to the show.
I want to ask you about some of your earnings tweets, but before we get into that, we had a viewer question, Bob, And they said, what importance should investors place on long-term bond auctions? Can an auction actually fail, as in having a bid to call ratio of less than 1?
Well, I think, I mean, auctions, the U.S. Treasury market is like the deepest, most liquid market in the world. And so like, can auctions fail? I mean, maybe technically the auctions could fail. I don't think that's not really the big deal thing. I think when you scan across, this is always the challenge in the bond market, particularly the U.S. government bond market, which is, will someone buy the bonds? Yes, someone will buy the bonds. Like that's going to happen. The question is, at what price will they buy the bonds, and what are the elasticities of all the different players in the market? Now, I went out, when bond yields were moving swiftly to 5, I was looking at the composition of the bond buyers, and I said, look, actually, we're seeing a lot of yield sensitive buyers coming in and starting to I mean, there's a reason why it's kind of like peaked literally at 5, right? It almost looked like there were a bunch of orders in place at 5, at a 5% yield. They're just like buy at 5% yield. Now, look, maybe it has to go higher than that in order to clear all the duration supply, or maybe Janet Yellen is going to just increase the bill issuance until we get a turn in economic activity, until there's enough supply, demand for duration, because the economy is deteriorating, in order to then in order to fill the duration supply gap. And so I would just like I think a lot of folks are looking at the bond market like when it was, at 2%. And not thinking about it at 5%. The bond market at 5% is totally different than the bond market at 2%. Totally different supply-demand composition, and particularly a reactive treasury. What would I say? Like, anyone who's drawing a line to yields to 13, which, to be clear, I was asked, like a serious person on CNBC asked me whether bond yields are going to go to 13. And I was like, no, that's not going to happen. Right? Like, you got to be kidding me. I almost laughed about it. That claim. Like, are we in the ballpark of what's going to clear the market at these levels, this amount of duration supply? Look, we're in the ballpark. Maybe it's got to go up 30 basis points or 50 basis points, but it's not 500 basis points.
Right. And Bob, that's a good call, not laughing at the CNBC people before, because I've done that and they don't ask me on anymore. So good.
I personally have PTSD dealing with the bond market. I mean, I don't, the long bond market for me is just like, it's the size of Apple's market share, the 10, 20, 30 in tips all combined. So, I have a suspicious feeling whenever the market's about to break down that, bonds pump 2 points and all of a sudden we're back on the rally terms again. So I personally don't like to play the long bond.
I think most of the easy money has just been made in the long bond, right?
Yeah.
When yields were in the mid 3s and, the economy is growing at 6 to 8%, you looked at it and said, it doesn't make any sense, right? Okay, so now we're in the ballpark of 5, like, should it be 5.25? Should it be 4.75? It's not the business I'm in terms, like, there's a lot more interesting opportunities that are out there. And remember, as a trader, you don't have to trade every market, right? You don't have to even have a view in any market. You just say, long end bonds, like in the ballpark, and move on.
Yep, exactly.
Yep. Hey, Bob, you had started getting a little bit into earnings, and earlier this week you wrote a tweet about Q3 earnings within the context of 8% nominal GDP. So, kind of dumb question. You talked about 6% earnings growth within the context of 8% nominal GDP. Can you help us understand why that matters?
Well, I think the basic question for the equity market is thinking about what's priced in. And I know, like, at some point, like, sometimes I start talking about what's priced in and people are like, that's so boring. Why are we talking about what's priced in? But when you're trading the market, you got to trade it against what's priced in. That's all there is to it. Analysts are expecting 12. We've had, pretty mediocre earnings growth. Like at the S&P 500 level, quarterly earnings has been, from a macro guy's perspective, you look at the numbers, you think, well, it's kind of been flat for 2 years, basically, right? I mean, it's up a little bit this quarter, it kind of wiggled up and down, but like basically flat. And I'm sitting there thinking, well, my God, the like GDP growth, nominal GDP growth has been about as good as it will like ever be in the rest of our lifetimes in the United States. And earnings are totally flat, you know, and it's like, okay, well, heck, what happens when things get worse? You know, like how are they going to meet that earnings growth expectation that sits in the market in the event that, you know, even in the good times, these companies are struggling to generate this type of nominal earnings that would get aligned with the types of expectations that are priced into the market. So that's the gap. That's the gap that I see. Like, and also to be clear, from that time, we've had interest rates rise a few hundred basis points. We've had, you know, on the short end, on the long end, we've had the global economy, Europe and the UK slowing down. Like, it's not like, you know, there's a boom out there. You know, and that's likely, you know, the impact on US companies is likely ahead rather than behind related to those issues as well.
Right. So, you know, we've talked about this before about, you know, the margin expansion that companies had over the last 2 years, that opportunity, that window closing, you know, it just seems to me that there are a lot of headwinds in terms of earnings growth going forward. Is that kind of what you're seeing? This, you know, nominal GDP, you say, is as good as it's going to get. Does it just seem like that window's closing for those companies and we're in for some difficult quarters ahead?
I think that again, from a macro perspective, when you look at it, like, how do companies make money? Either the top line sales have to grow really well, or they have to have margin expansion. And the way that you have margin expansion typically is through borrowing, the household in particular borrowing and spending, or their, you know, really what's happening is their incomes aren't keeping up with the top line sales growth. And when you look at that picture today, like on a forward-looking basis, it certainly looks like you've got a circumstance where like nominal GDP growth will be lower in the future than it has been over the last 2 years.
Yep.
For, you know, because we've tightened, because global economy is slowing, et cetera. And then you look at the margin picture and it's like, well, I mean, the labor markets are pretty tight. Wage growth is a lagging indicator. The big reason why those companies were able to get such good margin improvement during essentially like coming right out of the COVID crisis is because it just takes a while to negotiate the wages up. But now we're in a circumstance where, you know, some people say, well, real wage growth is a good thing. And I think it's a good thing for the individual spender, but it's actually a terrible thing for a company. Like, companies don't want real wage growth. Companies want negative real wage growth. They want their prices of their goods to rise a lot faster than what they're paying their workers, because that's when their margins expand. So real wage growth from a company perspective, which is driven by the tight labor markets and the flow through of the previous inflation to wages eventually coming through, that's a bad outlook. So, like, you know, I don't know, from a macro perspective, it's not looking good.
Yes.
No, certainly not. I mean, without question that inflation's masked a few of the earnings and, you know, boosted quite a few companies' earnings as the relative as volume has gone down. But, you know, it's going to come back to bite them in the ass sooner or later.
Yep, probably sooner. So, okay, hey Albert, let's jump to a little bit of discussion about the dollar, commodities, and elections. So, there were some elections in the U.S. this week. And a Republican presidential debate, which really nobody seemed to care about. Then Joe Manchin out of West Virginia announced that he won't run for re-election for the Senate in 2024. And you tweeted about this on Thursday. So why is that important? And what could that mean for things like congressional support for, say, Ukraine, for fiscal, for appointments in the next administration, that sort of thing?
Well, assuming that Biden still wins in 2024 and Manchin, because he's not going to run, Jim Justice, without question, is going to win that seat for the Republicans. And the Senate majority is so thin at the moment that this could pretty much spell that the GOP takes over the majority in both the House and the Senate. With a possible Biden second term, it's not going to be good for any kind of fiscal spending. It's not going to be good for very many bills out there, because there'll just be roadblocks left and right all over the place. You know, the margin, even today, the margin for the majority is so slim that they have problems passing things that are normally easy to pass, like the Farm Bill. That's a bipartisan thing that usually every 5 years gets rubber stamped and shipped off. But even that is looking, months down the road before that happens, which, going back to commodities, is great if you want to buy corn early 2024, because, I love corn going into Senate races and presidential elections.
40% off our AI-powered forecasting platform for a limited time only. Imagine being able to create and forecast your investment portfolios, with access to highly accurate forecasts for over 1,600 stocks, ETFs, Forex, commodities, market indices, and economics. CI Markets can help you make better investment decisions and save money, with its personalized dashboards, favorites page, customizable charts, and economic data analysis features. Sign up today and use the promo code SAVE200 at checkout. This offer ends on November 30th, so don't miss out.
Right. Okay. So with Republicans in charge, it's unlikely that we'd see like an Inflation Reduction Act Part 2 or something like that, which could help. Sorry, go ahead.
No, you're right. We're not going to see that unless we have some sort of market or economic breakdown where the GOP is getting scapegoated daily in the media, where they're going to be forced to pass something into an election year.
Right. So that could, I would think, conceptually help to avoid kind of a re-acceleration of inflation in 2025, maybe, right? I mean, I don't necessarily believe the fairy tale that Republicans are fiscally responsible, but I think it would, potentially help to avoid kind of a secondary or tertiary kind of reignition of inflation. So, and Powell has said that he wants to focus on controlling inflation. So can you help us really think through what that means in terms of obviously the fiscal environment, but also the dollar?
Well, I think that the dollar is one of the key tools they're using right now versus inflation. I do see it going up in 2024. I mean, there's weaknesses just all over the world. Bob mentioned slowdown in Asia, slowdown in Europe. The problem is that the dollar—
Japan can't get itself in order.
Japan, yeah, Korea, you name it,
Right.
But the problem I see with the dollar surging over 110, 113, 115 is you start breaking things globally, to the point where it transcends back to the United States market. And I don't think they want to see that. I mean, I think it was at 115 like a year ago, and Europe almost broke. I mean,
Right.
the euro down below parity. So it's certainly a problem for the dollar, being up that high, as in terms with the Republicans being, roadblocks or, in a majority. Everyone wants to say that they're conservative, fiscal, conscious people, but realistically, they have jobs, they have to be reelected, and their constituents want to get paid. So, I expect more, stimulus packages going into the next 2 years.
Okay. And we've got the dollar today. We've got the dollar at about 106, up from earlier in the week, last couple of weeks. So, it does seem like we're, there are setting some expectations for a stronger dollar already, based on.
I mean, it's crazy. We're at 106, 107, 104, 105 for like extended period of time, and it's like it hasn't done anything to our economy. It's actually quite interesting to see. Like Bob was saying, 1968, 1969, we're sitting here with all sorts of problems globally, and the dollar's strong as ever.
Right. So what would you expect? I mean, we've got oil that's pretty weak. We've got commodities that are pretty weak. What other impacts would you expect it to have?
Oh, man. Housing. Housing would be a big issue going into 2024. I mean, the White House and a lot of the Democrats want to see housing come down and make it more affordable. I don't see how you do that.
Right.
I mean, DC wants it, but boomers and other investors certainly don't want to see that break. So I don't know how that's going to pan out. I'm actually quite perplexed about the housing market.
Yeah, it's pretty sticky, right? Bob, what are you seeing in housing?
I think the most important thing on housing to recognize is that the composition of the housing market at a peak or a boom is just like totally different than at a freeze. And we're at a freeze, and we're at like a traditional standoff. They're both sides are staring at each other, that being the the buyers who want lower prices and the sellers who don't want to sell, and they're just kind of staring at each other. And usually what you usually need a catalyst in the housing market to start to create that price change. And like in 06, 07, we had a catalyst, which was there were a lot of floaters, right, and IOs that basically reset and totally hammered people, right? And so that was the catalyst back then. In this case, and if you go back in previous cycles before that, the catalyst is unemployment. And so the basic question is like, what's the catalyst today? Well, as long as incomes are okay and unemployment isn't deteriorating, like we can just stand and look at each other and basically have no transactions and have elevated levels of prices until you get to the point where, in particular, I think employment starts to deteriorate. And then what we're going to see is it's going to be a bloodbath, a fast moving bloodbath where the folks who are trying to dump their house onto the market are going to have absolutely no luck. So it'll be, if you have a house to sell, today's the day to do it, because tomorrow may be a lot more challenging.
Yeah. And I hear people say it's kind of Airbnb is going to, people selling Airbnb residences, all this sort of stuff. That may or may not happen. I think what you're saying is, well, maybe not what you're saying, but one way of interpreting that is if we start to see mass layoffs and people have to sell their houses to get cash, then we could really see prices drop pretty quickly. Right.
And the Airbnb thing, just there are 1 million Airbnb listings in the US. And like, okay, so what are you talking about? Like, most of the people who list their house on Airbnb live in their house, or it's their vacation house or whatever. It's not like the number of people who are buying like 12 apartments in Miami, on South Beach in order to lay it out for an Airbnb is pretty tiny in the scope of, hundreds, 100 million units that are out there in the market, right? Right. Airbnb will not be the catalyst. Unemployment, that could be a catalyst.
Right. Yeah.
And you don't even see like slowdown in hiring and construction, which would tell you that maybe the housing market's getting soft. I mean, there's no layoffs in the construction sector.
Yeah, that's right. I mean, it's basically, part of that's the multifamily. There's also these secular dynamics, which is basically the household formation has been, considerably elevated, making us millions of units short relative to household formation over the course of the last 15 years coming out of the financial crisis. And so, in some ways, a few Airbnb owners puking out their Airbnbs would actually be good, because there's some young couples who would love to live in those apartments at a slightly lower price than they can right now.
Yeah.
Yeah, well, there might be a microcosm to actually watch, because New York just banned Airbnb. So I'd like to see what the rental market does there in the next 6 months, see if there's some kind of like lowering of it. So,
yeah. Okay, that's great. So Albert's already said that he likes corn going into an election era. We've already talked a little bit about energy prices. Bob, you've already said commodities are probably a little bit undervalued right now. So let's talk a little bit about energy. Tracy talked earlier this week. Tracy, one of our regular guests, talked a little bit earlier this week about nuclear power. And last week we talked about wind and solar power projects being pulled because of higher interest rates and higher costs. So we had what's called an SMR project pulled, and I had to look that up. It's a small modular reactor. These are small nuclear reactors that are apparently much easier to deploy and maintain and this sort of stuff. So I'm not an expert here, but Albert really knows this stuff. And so there's a company called NewScale that shut down the first SMR project in the US because of costs. I think the cost rose something like 50, 60%. And again, this sounds similar to the wind story and the solar story that we talked about last week. So Albert, why are we seeing these costs elevated in nuclear? Is it is the option to pull these, is it partly because of interest rates, but partly because we're seeing other energy prices like crude and nat gas continue to drift lower?
Well, I'm sure it's a combination of it. I mean, I've known about these SMRs for like 20 years. I mean, these aren't new, by the way. Mitsubishi had prototypes out there years and years ago. The problem that they have is R&D. debt cost, interest rates, wage inflation, even being able to hire qualified people to even to put these projects into motion is very difficult. I mean, the biggest problem with those SMRs is like, okay, you build them, but how do you transport them? I mean, transporting a small nuclear device is not like putting in the back of a semi and hauling it across to Abilene, Texas. It doesn't work like that. There's big problems, and there's actually federal restrictions on with the EPA and whatnot. It's like, how do you put that thing 100 feet down, and how do you regulate it, and who's gonna come out and monitor? It's just, there's so many headwinds for SMRs that I don't think that's even a consideration for the next 50 years, in my opinion.
Okay, you can't just put it in the back of a Cybertruck and get the kind of green revolution, perfection.
Please don't give Elon any more fuel to go on Twitter and do any more tweets about Cybertrucks being nuclear powered.
Right.
Definitely don't.
Okay, so but that, I mean, look, last week we talked about wind and solar. This week we talk about nuclear. It almost feels like with the rise of interest rates, we're going to have to kind of double down on these old hydrocarbon generation feedstocks. Is that where we are? I mean, is that the end game? We've seen all this to green over the last 15 years. And is all that just resulting us going back to coal and oil and nat gas?
Well, of course. I mean, they're the most cost efficient and most stable power supply that we have, aside from nuclear. I mean, nuclear is on a different level, but I mean, look at Europe. Europe's an perfect example. They've tried wind and solar and whatnot. Germany's industrial sector was decimated for a few years because the wind and solar was giving fluctuations in the energy grid and destroying equipment. So I mean, these little calculations are not really like thought of whenever people start spinning this stuff up. But it's not as easy as turning on a switch and saying, oh, look, wind and power is on.
Right.
It's carbon neutral or whatever catchphrase you want to put out there.
Yeah, I don't want people to think we're anti-green. I mean, we've talked about
I'm
this,
not.
and it sounds almost like we're antagonistic to green. That's not the case at all. We're just taking a very realistic view on, okay, this requires capital investment at the start, right? And without the subsidies, without low interest rates, without other things, we get situations like, I think just today or yesterday, it was announced that the German government has to bail out Siemens with their wind business. So there's another green energy company that's being bailed out by a government. And, between the subsidies in China and the subsidies in Europe, and obviously with the IRA, the subsidies here in the US, it's really hard for those businesses to get moving.
Yeah, listen, I'm not anti-green or anti-environment by any stretch of the imagination, but like, people have to understand that things happen in increments. They don't just leap forward into some brand new technology or brand new, computing thing or whatever technology you want to throw out there. It's just, it doesn't work like that. It takes R&D, it takes time, it takes money, it takes testing, and so on and so forth. It's a progression, and that's what we should look for instead of jackpots.
Okay, let's move this back into, say, crude prices. We've seen crude prices fall pretty dramatically over the past few months. What's the outlook through the winter? Do we expect crude to stay pretty weak during the winter, and gas and are we going to see a winter like we saw in Europe last year where things spike? I mean, we're already in November and things already spiked by last November, but are we going to see that stuff rally back through the winter, or do you think we're kind of where we will be through the winter?
Things where I think probably, if you think just generally like which growth assets are priced cheaply versus more expensively, I think it's pretty clear that oil is priced cheaply in the scheme of things. Like, is it possible that we could have weaker growth ahead? It's certainly possible, weaker global growth, but oil is basically pricing in a pretty bad outcome. And I think, of course, one of the things to recognize is that there is a price sensitive seller in this market who will just start withdrawing supply if we get anywhere close to, frankly, much more than a drawdown than we're seeing in the December 24, Brent curve. Like, it's not going to take a ton more before before the Middle Eastern folks are going to start bringing oil off the market in order to support prices. And so I think in that risk return profile standpoint, right, you've got a pretty good profile. If I had to hold, a growth asset over the course of the next 6 months, oil looks like a better growth asset given the range of plausible outcomes than does, holding something like stocks.
Yeah, from what I was told, the $69 is problematic for U.S. production. So, that's somewhere where I would, probably go all in on at the moment. I'm long oil as it is at the moment anyways, but that's what I've heard is $69.
Okay, so we're at 73 today. So there, like Bob said, there's not a lot of downside, right?
No.
So we're
I think that's and look, like it's a classic example of a macro trade where, like, look, is it you trade these things not because there's certainty that it's going to go one direction or the other, right? You're looking for skewed outcomes. You're looking for good risk return profiles. You're looking for, a good range, particularly if you think, let's say, you're a little more concerned about the economy, right? You want a diversifying bet against, economic weakness. That's what you're trying to do, right? And I think, the long oil trade right now, I'm particularly struck below, in the 60s or something like that, out in December 24 looks compelling to me.
interesting. Very good. So that's good. I mean, let's keep it low while we can, right? So that's good. I really appreciate this. We've covered a lot of ground. Thank you very much for your time. Thanks for your thoughts, and have a great weekend and a great week ahead. Thanks a lot, guys.
Awesome. Thanks.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.